and kick things off. I think we've got some folks still trickling in. But for everyone who's here now, just wanted to thank you for joining us. This is the Exit Advisors now monthly town hall series that we started about a year ago. Also, happy St. Patrick's Day to everybody. If you're Irish, everyone's Irish today, I guess. But today we've got a really great panel, and the focus of it is going to be what different types of buyers are looking for when they want to make an acquisition. And our panel is kind of representing the various different types of buyers, which we'll get into in a minute. But the idea is we're going to look at their approach to making acquisitions, what they're looking for, how they're going to be valuing companies. And we're going to learn a little bit more about some of their specific due diligence processes and just hear from them on the different nuances with their acquisition process. I'll give a quick overview to Exit Advisors and our team. For those of you who do not know us, we're a Houston-based M&A advisory firm. We focus on the lower middle market. Most of what we do is sell-side representation, meaning we're working with the sellers and helping prepare them to get them in front of the guys that we're talking to today, the buyers. And most of you are probably familiar with our team. We've got the two managing partners, Gary Cooper and Al Danto, myself, and Casey Bright. And I'm actually going to let Casey take over real quick. He's going to dive a little bit more into the nuances of our process and how it's going to relate to the conversation today.
Thanks, Andrew. Yeah, today's topic is really relevant, I think, to what we do here at Exit Advisors, which is to prepare small business owners for an exit and maximize value kind of while doing it. So as you can see on this slide, we break down our process into 4 different phases, beginning with education. We pride ourselves as being kind of an education first firm in that approach, which helps our clients just better understand the process and really set expectations from the get-go. The second phase is what we call discovery. Discovery is a deep dive look under the hood just to understand the specific business, its value drivers, value killers relative to the industry, maybe its peers, and the overall market. The third phase is preparation. In this phase, we really attempt to address any of those kind of red flags or value killers, as I mentioned before, that may be holding back the business a little bit from either maximizing value or getting a higher multiple in the market, or just selling, at all. So we use this phase to really kind of prepare and collect information, and run kind of a pre-due diligence exercise so that they're really prepared for what's to come in the sales process. And the last phase is execution. In this phase, we kind of execute our go-to-market plan. This includes putting a bunch of deliverables together, pitch deck, a teaser, data room, amongst other things. So we handle all aspects of the marketing and negotiation process from start to finish. We're really here for our client to build a story and build their case to achieve an exit they're happy with. So that's our process, and I think as you hear from some of the folks on today's panel, you'll see what they're looking for and how that ties into kind of what we do for our clients at Exit Advisors.
And I think it's my fault. We even try to switch up the slides, but you'll see these are out of order: preparation and discovery. But thanks for the overview, Casey. And I'm going to go ahead and start introducing our panel members for today. We've got Jason Burinescu from Fletch Equity, and Jason's going to be representing kind of the private equity side of things. We've got Vik Bakshi from Seneca Trails Capital. Vik is representing the search funder, a funded search fund, and then Jason Mauricio with Endeavor Schools, who is kind of the strategic buyer. And so for the kind of first topic, I'd like for each of you, starting with Jason Burinescu, let's start. I want to hear from each of you about your motivations, the investment themes, the types of companies you're looking at, the size, the industry, what your ultimate end game is. And we'll see, obviously there's some financial buyers here, some strategic buyers, and what the overlap is. So let's start with you, Jason.
Sure. Hey guys, so I lead our business development group, which is focused on doing all of the sourcing and then working with the investment team to analyze investments and then ultimately go through due diligence. As a firm, we've done in excess of $1 billion of transactions as a team, 30 deals on the buy side, and so we focus on change of control transactions, typically in the $2 million to $20 million of EBITDA in the U.S. and then $5 million of EBITDA and above in Canada. And so we're generalists, and so we execute what's called a buy and build strategy. So we look for industries that are ripe for consolidation and highly fragmented. We'll kind of get into that a little bit later on, I'm sure. But we look for companies that are healthy, growing businesses where we can execute a buy and build. So do that through both organic and inorganic growth. And I would say the biggest differentiators for our firm are that, there's capital ultimately becomes a commodity. And so where we really add value is we tend to be the first institutional capital into family run and entrepreneurial run companies. So we're really comfortable in that position to really help build out the feature set of the business. So whether that means eliminating key man or key woman risk, or building out more technology capabilities, or diversifying the services, so that way, down the line, they're much more attractive for larger private equity and for strategics to get a premium multiple. And then the second and probably the biggest differentiator is that for every deal that we do, we bring in a really talented operating partner who's built a very meaningful business within this space. And so that way we're able to cover a lot of different areas. And so by way of example, right, we just bought 2 HVAC businesses and to build a platform and brought on a gentleman named Andy Mandel, who is the former CFO of one of the largest HVAC roll-ups in the country called CoolSys, which was acquired by Ares, and previously was the president and CEO of Valley Crest Landscaping, which is the largest landscaping company in the country, which was backed by Michael Dell's private equity firm and then acquired by KKR and taken public. We've done that in the motor coach space. We brought on we bought 2 businesses in that space and brought on the former CEO of Greyhound, grew that to the 4th largest motor coach company in the country. So we've done this across a number of different sectors. And so in terms of from a timeline, I would look at us as a traditional buyer in terms of, we look for a 5-year horizon. It could vary from 4 to 7 years typically. But in terms of motivation, we look for really talented management, people who want to, grow a business, who have the same ethics as we do in terms of, straightforward, hardworking, and ultimately, generate a strong return for our investors. And we've been fortunate to do that over 30 deals.
Awesome, thank you. Vik, you wanna chime in now?
Sure. Yeah. So there's probably a lot of overlap with what Jason just talked about for me personally, but I'm kind of representing 2 different groups here. So you have folks that are called searchers. We run search funds, and there are some like myself that are funded, as in I've received some seed capital from a group of investors, and I know who my capital source is going forward in a deal. And then there are other folks, like a lot of buddies of mine, who are self-funded, as in they're running a search for a business, but without institutional capital backing them. And they're usually looking to finance a deal using the Small Business Administration loan program. But in either case, you have 1 person or 2 people that are running a search to acquire a business. And ultimately, folks like myself, as much as we might have some backing from private equity firms, rather than viewing ourselves as purely a financial buyer, it's more of an aspiring CEO, an aspiring operator who wants to buy an existing business that has a lot of characteristics that would point to stability and predictability, and wants to transition that business from the existing owner operator for someone like myself to run the business. So there can be various reasons someone might sell a business. Maybe they're just ready to get their chips off the table. Maybe unfortunately they're dealing with some health issues or some personal issues, but the ideal situation is looking for an owner operator who's ready to retire and wants to transition that business. And so they're probably trying to solve for 2 problems. One is, how do I get a fair price for this business to make sure that I can see the rewards from all the work that I put in and reap those benefits as I go into retirement? And then 2, if I sell the business, who the heck is going to operate this thing? And that's where a searcher comes along and is trying to prove to you that, hey, not only do I have the capital to facilitate a deal at a valuation that we both agree upon, but more importantly, that by selling to me, your employees are going to be taken care of, your customers are going to be taken care of, your company's going to remain intact, and essentially your legacy will be carried forward in the form of this business as a going concern. In terms of hold period, I think it really varies. Someone like myself, where I'm bringing backing from institutional private equity firms, just like Jason mentioned, I would probably be looking for a 4 to 7 year hold period. And then even if we were to sell, maybe I would continue to stay on as the CEO. Some of my buddies that are running these self-funded searchers, they're really more of someone who's trying to be in your shoes and is trying to hold that business long-term. So they would be really looking to hold that business indefinitely. In terms of size, it kind of varies depending on those profiles. Myself, I look for deals that are anywhere from $10 to $30 million in revenue and about $2 to $5 million in EBITDA, which is a term that Andrew and Casey could tell you a little bit more about if you're less familiar, but it's our proxy for annual cash flow. Some of the folks that might be looking for something even smaller that they're going to hold indefinitely, they would be looking at businesses that are maybe in the range of $3 to $10 million in revenue and about $500K to up to $2 million in sellers' discretionary earnings. In either case, we're looking for businesses that are very stable, very predictable revenues and profitability. There, has there been moderate growth, not a lot of fluctuation in terms of the cash flow, and really a business that someone like myself who is looking to operate it long term can step in and know that there's not a lot of volatility and it's not a turnaround situation.
Awesome, thank you. And then Jason, Mauricio, why don't you wrap things up and give an introduction and overview?
Sure, thank you. Not too dissimilar. We're doing a lot of the same things. Maybe as a strategic buyer, I would say the main difference to us is that we don't necessarily have a hold period in mind. I mean, we certainly have a valuation period that we underwrite. But our whole thesis here is to buy and hold indefinitely, or buy and operate, I should say. So our specialty is the early education and K through 12 space. Our company, Endeavor Schools, we started in 2012, and we've gone the last sort of eight and a half years to from 0 to about 60 schools. And we've not, since in that time period, we haven't exited any of them. We look for high quality preschools that we can, predominantly high quality preschools that we can operate and continue to grow and add value and professionalize. And what we're finding is similar to Vik and Jason, some sellers want to retire, have health issues, personal issues, looking to move away from the business or do something different. And they'd like to see their schools continue to operate, continue to serve their communities. And so they look for us to maintain that continuity. And we do so in a way that kind of professionalizes the industry. And then we support those schools as well through our sort of operating back-end infrastructure. And so that's where we add the most value to our sellers and to the schools that we're buying.
Great, thanks. Well, for our next piece, Jason, I'm going to stick with you for the kind of the first part. To acquire a business, you have to find a business, and sourcing and screening, it's a challenge for everybody. So from your perspective, how do you find a business that you want to acquire? What are just some of the methods that you undertake?
Sure. So I'll actually start with the second bullet point here first. And so as I mentioned before, we look predominantly in the preschool space, but also the K through 12 space. We're looking for, we have a very defined market segment. We're looking for private schools. So not charter, not magnet, none of those sort of things. We're looking for private schools, independent, generally non-sectarian, and in kind of key market segments. So we're in sort of major MSAs, if you will. As far as sourcing, historically, our deals have come in through brokers. So that's how we got to know Exit Advisors. There's a handful of folks that specialize in this space, and then there's certain regional brokers that have brought us deals. So generally speaking, we've gone the broker route. Over the last 2-3 years, we've made a bigger effort into sourcing our own deals, and we've sort of put some infrastructure and tools around that to help us identify schools that would meet our criteria, and then doing our own internal outreach. it's a tricky one because a lot of the brokers add a lot of value in terms of how we approach things. So, this isn't meant to be a plug necessarily for exit advisors, but it will be. Brokers can typically have sellers well organized and familiar with the sale process. And if you think about the typical seller that we deal with, it's kind of like moving. You want to do so as little as possible. Many of our sellers have never sold a business before. They don't know what the processes is or the norms. So having someone like exit advisors kind of manage them through that process and make sure their information is available and organized is a pretty critical step. It helps us move through transactions a little quicker. And kind of like how painful moving is, if you can do it a little quicker and faster and more organized, it's less painful. For us, maybe on this third point here, we're not looking for turnaround stories. We're really not set up that way. We do feel like we add some value to the acquisitions we make, but we're really looking for just a high quality preschool that's been operating well historically and something that we can take over, perhaps professionalize a little bit. We're not really looking for massive margin improvement or cost cutting or anything like that. Our whole premise is we're just trying to grow our scale. And so we typically like and prefer premium, high quality schools operating at high level of profitability, and expect to maintain that.
Perfect. Vik, I want to hear from you next. Same question about sourcing and also looking at industries and markets, because although now you've probably honed in on something very specific, i.e. you're under LOI, as we know now, as of last Friday, and congrats there. But maybe from the perspective of when you were first starting the search fund, or from the eyes of other searchers that might have a broader scope of what they look for, how does a searcher source deals and screen them?
Sure. So maybe I'll jump to the industries and markets point first with that in mind. So, searchers like myself, we have certain criteria that we look for in a business, certain characteristics. And so one of those would be what I would call revenue stability. So how predictable are those revenues? And our preference is businesses that have some type of subscription model or recurring revenue where we know the revenue is secured via contract. And then from there, you can go to other forms, which are still attractive, but maybe are less certain. I look at a lot of businesses that have a lot of repeat revenue. So we can show over time that, hey, for the last 5 years, 80 to 90% of the revenue has come from existing customers year over year, and there's very little churn. And then you might look at something like a project-based revenue, which can be profitable, but is a lot less predictable. So one would be the types of revenue, certainly the size of business, the margins. Another characteristic that's really important to me is the free cash flow margin. So someone might say, and these are real numbers of a company I'm thinking about, I have $3 million of profit. And it's like, yeah, you do, but you have $2 million of capital expenses every year to replace trucks and maintain them. So really you have $1 million of profit. So that'd be another one. Anyways, using those characteristics, we would think about, well, what are different industries that have those characteristics when we look at the types of small businesses that are in them. And we tend to look for what we call B2B services. So business to business service providers, because there's a higher likelihood of that business having some type of service that's sticky. And so there's better predictability to the revenue and to the margins. All that to say, the industries that people end up defacting to, I think, ends up reflecting a bit of interest. So for me, I look at what are called old school industries. So a lot of heavy industrial maintenance, distribution, waste services, cleanup services in different heavy sectors of the economy. So like manufacturing, automotive, aerospace, defense, a lot in energy, et cetera. Whereas I have a lot of friends that look at kind of healthcare or tech or other things that might seem sexier. All that to say, once I pick an industry thesis, like, hey, I really want to explore this space, then I get into deal sourcing, where personally what I would do is build a list of literally hundreds of small businesses from a private database or from public data. So from public data, maybe like a list of businesses from a chamber of commerce, or PPP loan data is publicly available, et cetera. Or I can use access to a private database to build a list of targets. And then, like Jason mentioned, then you go into your internal outreach, and there's a lot of technology we use to be more efficient when contacting hundreds of business owners. That is one method, and it tends to be the norm for searchers. I myself, and again, this is a bit of a plug for brokers, I myself much prefer using the brokered network. I think that candidly, I think for me as a buyer, the deals are more expensive because I'm paying for a process that was more competitive. So the price probably got bid up, and the brokers, essentially their fee is probably baked into the price that I'm paying. Having said that, it's much more organized. The information is clear and easy to understand. And I know that it's a very credible seller that someone has vetted over a period of time to make sure they're serious about selling. So that's my preference, is the broker route. And that's how I was able to get a deal under LOI recently.
Great. Jason B., you want to round it out?
Yeah, sure. So, we're generalists, so we cover, a number of industries, everything from home and commercial services, healthcare services, environmental services. We like general recurring maintenance service businesses or technology. In terms of, the types of ways we source deals, a lot of it is we have a very big database of brokers that we're constantly in contact with. We do a lot of direct outreach as well. And I would say the other piece that we see a lot of success in is, while we have industries that we focus on, a lot of the deals that we have are just turning over a lot of rocks and finding, really interesting businesses. We bought a maintenance service businesses that services private aircraft on the Gulfstream platform. We weren't specifically looking for that, but it turned into be a really great business with good management. Same thing with a fitness chain that we ended up acquiring 2 businesses in that space. But I would say the other piece is that we're also happy to pay buy-side fees. And so there's a lot of times we build relationships, like with Exit, where they may not even personally represent that deal, but there may be opportunities where they just have a lot of data in the market, right? So they just know a lot of things that are happening. It could be, my friend is selling a business. I have a family member who may be looking to exit, and there's opportunities that way. In terms of coming through brokers, we certainly like that because for the reasons everybody else mentioned on the call.
Perfect. Thank you. So the next topic, there's obviously going to be some overlap here with what makes a business attractive and how you find it to what makes it valuable. So Vik, why don't you kick this off? I'm curious to see, how do you begin the valuation process for a business, and what are some of the, obviously, I think, again, a lot of overlap probably between the 3 of you with quantitative methods, but maybe there's some qualitative stuff like, the dependency on the owner, some of the intangibles of a business. Anyways, how do you go about valuing a business?
Hey, Vik, I think you're muted.
There you
So
go.
by the time I'm getting on the phone with a business owner, I have a sense for what that industry normally trades at. So, hey, businesses normally sell in this industry for 3 to 5 times what their annual cash flow is, or 5 to 6, or whatever the case might be. And then it's a matter of saying, well, how good of a business is this within that industry? And that helps because I think, frankly, if an owner has a really outrageous valuation expectation, it allows me to quickly move on because I'm not going to get there. There is certainly an element of quantitative, trying to dig into, well, how much revenue did you have this year versus last year, the year before? Obviously, 2020 is a pretty significant one when we think about margins and where a business's revenue might be. For me, the qualitative stuff starts to be a lot of the softer things like, hey, why did you start this business? And more importantly, why are you selling it? What's your time frame here? Are you thinking, hey, I want to sell in the next 2 or 3 years? Because for me, I don't have that kind of time. Or are you at the point where you're serious about selling and you're ready to make a transition here in the next 6 months? Do you have family members in the business? Because if you do, that can, certainly I respect that, but that can create a lot of complexity around what does it look like going forward for me when your son's in the business and has been involved for 20 years. Are you the only owner, or is it going to be kind of complicated between multiple stakeholders? And then, over time, if it looks like an attractive business, for me personally, I have to move there and I have to go live this business. This is going to become my life. And so I really want to understand, obviously, the location, but what's the culture of the business like? What does it feel like on a day-to-day? Are employees happy, or are they really ticked off at the last owner? Some of those softer things really matter a lot more to me than it might to some other types of buyers.
Great. Jason M., how about you? What are some of the, quantitative or qualitative methods for valuing a business that you look for?
One of the first things we look for is the quality of the program. So when you think about preschool space, we're very selective. We really like schools with very defined curriculums that have a track record for and reputation for being early education. There's a lot of daycares or just childcare facilities around. We don't feel like there's a lot of differentiation there. And so for us, it's the differentiation is early education. From there, I would echo a lot of things that Vik said. Having family in the school is a thorny issue. Has the seller actually positioned someone to maintain the leadership of that school after they're gone? And then from a quantitative standpoint, we have minimum standards set forth by our board and our investors. And so we have a minimum EBITDA threshold of 400 to 500,000 per location, and we try to stick to those. Essentially, that's it. I mean, we have some demographic criteria that we try to stay true to, but really the sort of the talent on the ground and the program is really what we're looking for and evaluating. If that and the minimum EBITDA holds true, then we feel pretty comfortable about buying the school.
Perfect. Jason B., so as far as drivers of value or destroyers, maybe focus on destroyers. What's like one of the biggest, in your opinion, drivers? What would increase the value of a business the most, and then what would destroy the value of the business the most?
Sure. I mean, I think we look at it from two things. One is the initial transaction, right? And then the other thing is the execution. So if you're an owner of a business and you want to roll equity in that business, what does that second bite at the apple look like, right? And a lot of times, if we do our job as well, the second bite of the apple potentially could be more lucrative than the first bite for the owner. And so, in terms of premium valuations, we look for somebody who's, high quality management, who has a real strategic vision and understands the culture of the business and really wants to see it grow. They have a strategic plan to really focus on that growth. So that could be, hey, we want this capital potentially to take some chips off the table, but really we see very specific strategic initiatives that we can execute over the next few years, and that's going to add a lot of value. And so by adding value, there's really kind of three ways of doing that, right? So it's increasing earnings growth, it's decreasing your debt, and then ultimately getting multiple expansion, which means if you can get a business at let's call it $2 million of EBITDA and grow it to $10 million of EBITDA, and not only are you going to get a larger valuation for the business because it's got larger earnings, but you're also, because now the business is more stable and larger, it's going to get a more premium multiple. So if you buy the business maybe for 4 or 5 times, potentially you can sell it for 10 or 11 times, that math becomes really appealing. And the other thing is just, when we're working through a process with somebody, it becomes very qualitative, right? This is essentially becoming a marriage, right? So you really need to be comfortable with the person. If there's issues that come up, inevitably there always are, or is the other person on the other side of the table working to solve the problems, or is it more, adversarial? In terms of destroyers of value, same thing. Their poor personality traits, is there poor delegation of responsibility, is there lack of focus? Are we not getting the data, promptly? Does the entrepreneur not understand their data? And those would be certain things that we would kind of look at as a detriment to the value.
If you were a business owner and you had to stand out, what's the number one thing? If I'm a business owner, what should I do to stand out? How do I make myself most attractive?
Yeah, it's a really good question. So there's a few things. One is, know your numbers inside and out. Really, it's not dissimilar probably to watching Shark Tank, right? You want to kind of know your numbers, understand the business inside and out, really kind of eat, sleep, and breathe that business, so you can just kind of get a sense of someone who's passionate about what they're doing. Is it always on their mind? Do they really want to build this business? Because it's a lot of energy. I would say those two things in terms of, looking at the metrics of those things, I would say that it's, is all the revenue dependent on one person? And if that person leaves, now all of a sudden the business is at risk. Is there tons of customer concentration, right? So once you get rid of those kind of core elements of what the business is steady, it's really about the management team, and the culture is really what we look for.
Awesome. Vik, you want to wrap up on the same note, what you can do to stand out?
Sure. So I think the biggest thing, would echo everything that Jason just said. I think the biggest thing is demonstrating the ability to grow that business. And so, the biggest driver for me is growth. And probably the second biggest is margin, because if I have enough cash flow, then I know I can reinvest cash into the business in order to consider growing it. And ultimately, that's the best way that as a buyer that I can create value in that business. And so if a business owner wants to stand out, I want someone that can tell me credibly, like, look, this is how much we've grown historically, and this is how much you could grow. And these are all the things that you would need to do it. A lot of times we look at a business owner and we say, like, well, if it's that easy, how come you haven't done it? And I think having a credible story there of like, well, I could, but I don't want to invest the time or the energy, or I didn't want to reinvest cash flow. I wanted to harvest it. But a buyer like yourself could do these things to grow that business. I think that creates a credible case. And then knowing that, hey, if the business is able to grow at the levels that we're projecting, or is the infrastructure in place in order to support that growth? So we have the right people, we have the right processes and the right systems, so that, hey, actually, if we come in and add a bunch of customers or are able to grow sales, we're not going to find ourselves in a huge operational nightmare where we can't actually support at the same level of service. And as far as destroyers of value, absolutely the same. I mean, the big customer concentration or employee concentration where, hey, if we lose one person or one customer, this business is essentially worth half as much. And by the way, I just took out, millions of dollars of debt. That's going to be a big deal.
Gotcha. All right. Well, now I'm going to segue into kind of the final topic before we get into some Q&A, and it's really the meat of an acquisition or a transaction, and it's due diligence. So I'm going to start off with Jason M. And again, a lot of overlap here with valuation drivers, but for due diligence, what are maybe the top three most important things that you do or look for when you conduct your due diligence process? And that can be a single thing that you look for, or it can be a process like conducting a quality of earnings, that sort of thing. Just kind of dive into what due diligence looks like for you.
Sure. For us, we've broken it down to really three key things. So it's a very easy question to answer. So number one is revenue. I think everyone will agree that's the most important thing. But we look at stability of revenues, what kind of pricing power the school has had over time, and have they been able to increase prices on a regular basis in line with inflation? And then does revenue tie back to what they've reported? And that's where the QOV process really comes in. The second key thing that we look for that we kind of do ourselves, and we have a proprietary way of looking at it, is just staffing. If you think about our preschool, staffing is the number one expense. And so getting staffing wrong has a big impact to what our long-term valuations hold up to. And so, I'd probably piggyback on one of the earlier topics, but if we look at, the one area that destroys value in a school, it's how the owner has treated and or managed staffing over the course of time. Because oftentimes we'll take over a school and we'll realize the owners were cutting corners or weren't doing things right, and we'd have to remediate that. And if you recognize that a lot of preschools are regulated by the state, and so have licensing requirements, that puts the school at risk on multiple levels. So staffing is extremely important for us and something that we look at very, very carefully. And then the third is the real estate. So if you keep in mind, we're stepping into long-term leases. We want long-term leases. So in that case, we're really aligned with some of our partners. But is the roof in good condition? Are there issues in the real estate that or in the building that's going to cause us to step in and remediate more than what we've underwritten? These are all things that have huge impacts to our long-term returns, and so I would say those are the kind of three most important areas to us, which And I would rank them in those sort of those orders: revenue, staffing, and the real estate.
Okay, thanks. Jason B, I want to hear from you now. Same kind of question, most important points, but I want to peel it back a layer. And I want to start with Jason Mauricio's comment of, revenue being the most important versus, perhaps some people value margin expansion or EBITDA growth versus revenue growth. Do you concur with that, or do you prefer seeing a clean top line, or does bottom line matter more to you?
So, obviously it depends on the industry that you're focusing in on. And as generalists, it's varied. Certainly we want to see growth in the business, right? So obviously if we can grow the revenue, that's a big piece of it. Ultimately, a lot of the businesses that we invest in are going to be trading on EBITDA. So we need to drive both top and bottom line. So those are, again, if we went industry by industry and kind of walk through the different layouts of that, then I'm happy to answer questions later on about that. But so it would be both for us. Again, we start with a healthy growing business and want to figure out how can we grow that, again, both through acquisition and also organically. And so we want to see, the core business growing over the last 3 years, ideally. And then if we can add in other acquisitions, we might be able to cut out different costs, which will honestly drop to the bottom line, right?
Yeah, I really very, very important point about depending on the industry. And we did have some questions come through about that, which we're going to elaborate on in Q&A. Vik, I'd like to ask you now more about the process, especially relevant now that you've just gone under LOI with a potential acquisition. You're about to kick off a very, very heavy due diligence process. What are some of the tools and processes that you're going to implement to help you? But, you could flip this upside down and say, the sellers could kind of have this, prearranged to help expedite the process and keep it clean and transparent. What's it going to look like for you?
Yeah, so I think the characteristics of how I want my diligence process to go, or the things that I'm trying to make sure that I'm bringing to the table, is being organized, communicating well with all parties, and being very transparent. And so the way I'm trying to make sure that happens in terms of kind of techniques or tools, et cetera, is having very clear timelines that I can publish both to the seller and to the owner, both to the seller and to my investors, that are updated regularly. I make sure that I have standing calls with all of those folks, and that I'm sending at least weekly check-in emails so that they can see that, hey, this process is moving along, and it gives everyone more certainty. It also allows us to flag any issues before they become bigger issues, and get people involved with solutions oriented. So I think my advice for an owner is, one, making sure all your information is really organized. And I think that goes back to, if you're at the point that you're thinking about selling your business, you should probably start getting that information organized, and you can talk to other sellers who have recently sold, or business owners, or business brokers, and find out, well, what are the types of information that I'm going to need besides my financials? And there's a lot. People are going to want to see your insurance records, if you've had any claims, if you've had any litigation, if there's any environmental compliance, lists of who your major suppliers are, and the history for all your major customers. So the more you can get that information organized in advance, the more attractive your business becomes, and also the smoother the process will be, which gives you a higher likelihood of close.
Yeah, I would really reiterate that, especially from our perspective. Organization and transparency is so important, because being able to, it's an indication of how you run your company. You might have a very clean company, great financials, but if someone's requesting documentation and you can't produce it, it's kind of a reflection of how unorganized you are. And so, advice to the business owners here of making sure your ducks are in a row, because it speeds up the process. It's an indicator of how efficient and clean you are. I'd even argue, if you do have some hypothetical skeletons in the closet, having them kind of upfront and made aware, and that they're being dealt with appropriately, rather than, not really hiding them away and not understanding how they're impacting you, is far worse than just getting it out there. And we've definitely experienced that from our perspective. And so that's part of our job, is to help clean up and make sure that you are organized. But a lot of that it's done, way ahead of time. And that can mean organizing your contracts, your employment agreements, not just your financials. So, well, I want to save some time for Q&A. So I have two more, questions that I'd like to ask everyone. Would love to hear just like a total deal breaker or kind of horror story that you've experienced, without mentioning any names, obviously. But, what's an example of just something that it just completely fell through because of a certain thing or reason? Let's start off with Jason B.
Sure. I mean, again, I'll talk a little generally. So, the biggest thing again is it's transparency, it's honesty, it's having the kind of the same morality or doing the right thing type of culture. And so if you're obviously lying about your numbers, that's a big deal. If they're inconsistent, I would say that's the biggest red flag. The second is if you have a seller who is just the bedside manner is really off, right? Because again, you're getting into a relationship where we're putting, potentially millions, if not tens of millions of dollars into a business to work together for the next, 4 to 7 years. You want to make sure that you can have disagreements over that time and work to solve problems. So if you have somebody who's very adversarial and, that's kind of a big issue that we've seen a number of times.
Great. Jason M., any horror stories, any deals that have fallen through?
It's we've had some deals come on the bubble because of things like licensing issues. We've been able to mostly work through those. We oddly had a deal fall apart at the last minute because of some zoning issues, which was really unfortunate. You can't be zoned for preschool everywhere, and some sellers get special use permits. And sometimes, like very rarely, those aren't grandfathered in. And so we actually had a deal fall apart because if we were to transact, we wouldn't be able to continue with the zoning. We've had deals delayed because of that, and we've had to go to court. Generally speaking, once we commit to an LOI, so I would say our pre-LOI diligence is a little more intensive than maybe normal. Because once we do go under LOI, it's very rare that we back out of a deal or we don't do what we say we're going to do. And so it's usually those kind of gotchas, the stuff you can't really diligence prior to that, and stuff like that gets in the way. We've had some pretty funny stories though. We had sellers that were going through a divorce, and the judge made the owner sell the business, but the husband didn't want to. And in order to sign the paperwork for the transaction, the police actually had to go and arrest the guy, bring him to the courthouse. And the judge told him, you either sign the paperwork or you go to jail. And so under arrest, the guy ended up signing the paperwork to sell the school. It was a pretty crazy story. And I think there's actually a recent deal we had where one of the owners was actually staying at the facility overnight. So I guess had some non-disclosed marital issues and was sleeping in the facility. So when we got there, when we were doing our tour, we actually saw like a bunk, not a bunk bed, but like a bunk, like a cot that they were sleeping on. It was really bizarre.
Oh man.
So lots of fun stories. One deal that fell apart because of some zoning issues. But for the most part, we've closed over a lot of stuff. And I think I would echo what Jason said. Transparency, integrity are pretty important. We've had deals that we've had to go back and talk about because an area that we talk about a lot is RPS, revenue per student. And one of the sellers he was not day-to-day in the school. And so when we were initially talking, he overrepresented the revenue per student. That had a major impact on the bottom line that he was telling us the school could do. So we had to have some discussions over stuff like that. But to the extent that, to echo your thing, Andrew, being organized, knowing your numbers, in being transparent about this stuff makes the deal go a lot smoother, and we don't have to have follow-on conversations.
All right, Vik, I know.
Clarify, we tend to close 90%, of the deal. Same thing when we go into LOI, we close 90% of the deals, if not more, once we go into that. So we work through a lot of the issues pretty cleanly.
Good. It's good to hear. Vik, I know you're just under LOI, so fingers crossed, hopefully you don't have to have a deal breaker, but maybe from the perspective of having to get to that point, saying no so many times, what was just like the number one, it looked attractive at first and then you got into it and it just, you're like, holy shit, it exploded. What, give us an example.
It's almost always the numbers. I'll circle back to that. I have had one where like, I was starting to get a little bit dubious about the numbers. And then one of my investors was like, hey, have you seen this guy's Google reviews? And it turned out all the employee reviews on like Google and Glassdoor and everything else were saying like really negative things about the owner. And all of a sudden I realized this isn't someone I want to be in business with, even for a 6-month transition, let alone inheriting whatever skeletons he has in the closet. More often than not, it's the numbers. I had one business that was a large defense contractor, so it's a very project-based business. And when I made an offer, it was knowing that they had just landed a massive, like $50 million contract for a defense program that was going to stretch out over a few years. And as time went on throughout the negotiation process, and I kept asking for updates on their pipeline of deals, I realized, oh, I valued the business based on that $50 million contract, but he's executing it as quickly as he can. And it's basically going to be gone by the time I buy the business. So that's a pretty big issue. Another one I've seen is just more so in an asset intensive business. Again, I gave someone a valuation knowing that he had $3 million or so in annual profit. And I said, yeah, you probably have like $1 million, maybe $1.5 million in CapEx, which he agreed at the time that we were setting the initial price. And then come to find out, like, no, he really has $2 to $2.5 million in annual CapEx. And at that magnitude, you're talking about like, oh, I'm going into a negotiation thinking you have $2 million of free cash flow, and you in your head know you have like 500K to 750.
That's interesting. All right, so in like 30 seconds, because I want to save time for Q&A, maybe max a minute. From each of you, is it a buyer's market right now? Is it a seller's market? Look at the state of the economy. What is it right now? Maybe in 12 months, and why? I know that's a loaded question for 45 seconds, but let's hear it. Jason M.
I think we're in a temporary buyer's market, just because I know some of the big buyers that we compete with are on the sidelines still. I don't think that's going to last for much longer. So I would expect maybe as of this summer and maybe into the fall, it'll start to become a seller's market again. So we're trying to do what we can at the moment. But yeah, I think it's a temporary buyer's market, probably a seller's market longer term.
Jason B.
We're seeing it's a seller's market at this point. Again, we cover a lot of different industries. You're seeing the big thing though is it's a seller's market, but you also have a lot of these things happening with capital gains potentially changing in 2021. So I think you're getting 2022. So you're having a lot of people get off the sidelines and move aggressively. So we're seeing a lot more deal flow, but we believe it's a seller's market at this point. In terms of long term, I wish I knew, because we would we'd be able to do a lot of great things that way.
Vik?
I said this the other day, it always feels like a seller's market. Multiples are always trending upwards. And I think unless you're distressed, the advantage is always to the seller. And I would say specifically right now, as a result of the pandemic and the recession, you have fewer businesses that are really attractive in terms of characteristics that people look for. And so there's a smaller supply, there's the same demand of potential buyers out there, prices are going up. It always feels like a seller's market to me.
And for whatever it's worth, I agree with all of you, and probably lean closer to Jason and Mauricio. I think we actually wrote a white paper on it, and it was mainly focused around COVID impacting M&A, but and you can check that out on our website. But it's still a seller's market, but I think with the impending and highly probable tax implications that are going to hit within the next 12 to 18 months, that it could shift pretty quickly. So point being, I agree, it is a seller's market at the moment, but I do think we could see kind of a shift coming. So we've got some really good questions that have come through. I want to try to tackle all of them. And I guess I'll open it. There's some that are specific, but I'm going to open this up to anyone who wants to chime in. And I know Jason and well, probably all of you have had some sort of background dealing or looking at least at IT companies. And so one of the questions is, do you have any guidance or any advice on what to look for when purchasing, an IT or a software as a service company?
For Jason B, you want me to?
Sure. Yeah, go for it.
So I think it depends on what stage you're looking at. I mean, if you're not talking about venture capital, or obviously I actually came out of the SaaS space at a cyber security company that was venture backed by Battery Ventures that was ultimately acquired. And so, when you're talking about kind of the Silicon Valley startups pre-revenue, you're talking about major multiples based on concept and ultimately trading on revenue. In terms of more traditional, what we do in terms of a little bit more mature businesses, the big thing is, same things as kind of core businesses. So customer concentration, what does that look like? Typically, you want to see 90% retention. So it's a SaaS business, right? So the idea is this business sticky once there's what's called a land and expand strategy a lot of times in these software businesses, which is you get into a company, even if it's a small deal, and you become so valuable to them that they ultimately will grow and grow and grow, and you'll be more sticky with them and stay long-term. And so we look at that as a proxy for how strong is the product integrating into companies, right? So if 90% means that you're retaining 9 out of 10 customers, you're able to hopefully grow that spend to something else you're going to look for, right? So our clients using the product and then expanding the services, if it's certainly by a per seat basis, if they're doing a small trial and then expanding, that's something we would look at. In terms of the diversity of services, we would look at that. So, what market are they going after? Again, if you're looking more from a venture capital model, what is the TAM or total addressable market? You want to have a big space where there's a lot of opportunity to grow into the sector. And then I think a lot of things come back to the same thing, right? Core management, is there a good process? Are they, is the product constantly improving? Are you getting good feedback on the product? Is there a sales process in terms of growing that business? Those would be kind of some of the core things we would look at. And if it's more kind of a transformational business, same thing. So we don't like project-based businesses just because we like the recurring revenue stream. So it's always easier to retain a client than to get a new one. And so if you can go in and do more of an ongoing revenue stream component, we like that as well.
Yeah, I agree. We've had and currently have some software as a service clients, and things that we've looked at. You pretty much nailed all of them. The customer acquisition costs, the retention, or you can also look at that as a churn rate. Anything sub 10%, 5%, I think is like the ideal, the standard, which is really hard. Yeah. Meaning that you're not turning over your customers and having to pay for them every cycle. And then I don't know if I heard this, and forgive me if you did say it, but I think looking at the recurring revenue and what revenue, and really scrutinizing what's actually recurring versus maybe project based or even cyclical. If it's really genuinely recurring revenue, that's really important. And then I did not hear this, but I think looking at the kind of intellectual property of it, are they just like a software distributor, or do they actually own their own IP? Do they develop, in-house, that sort of thing? And just for the sake of time, I'm going to move on. I'm sure you all have opinions on that, but another question we had was directed at Jason Mauricio. How do you manage and do really an intense pre-LOI due diligence if it's a competitive process with a timeline? Does your approach sometimes turn off some sellers or brokers, and how do you handle it?
Yeah, I mean, a lot of it is, since we're in predominantly the early education space, a lot of these schools need to be licensed. And so there'll be records online with the state licensing that are publicly available. So we could see how, historically the school has operated and have they been true to licensing. I think Vik mentioned it earlier, Google reviews and Yelp reviews and these sort of things help. And then it's worth noting that we have, 50 plus schools across the country. Knowing how our own business operates has allowed us to build some proprietary tools where we can put in some pretty basic information and spit out if the financials and other things the school are presenting ring true. And if there's big divergences, then we can kick the tires a little bit more. And then we do like to talk to the sellers pre-LOI and just do a little conversation with them, understand their backstory, get a sense of what their culture is and how they run the school. And to be honest, it doesn't turn off most brokers or sellers. I think there's a reasonable expectation that we want to go in and do the best we can with our offer. I find that the less sophisticated the brokers are, one is the more unrealistic the valuations are, and also the more frustrated they get when we have to for the work that we make them do pre-LOI. And those are kind of deals that we're pretty happy to maybe walk away from or not work so hard for, because we realize that there's going to be some expectation differences between our approaches. So I think combination of, there's a lot of easy stuff we can do pre-LOI. We have some proprietary tools that help us get us there. And if someone's not happy with that process, if they don't want the examination, then we're not going to put capital at risk for that.
Perfect. All right, so we the last two questions, I'm going to try to merge these into kind of one, and I'm going to start with Vik, and then time permitting, we'll just let everyone kind of chime in. But the first is, what are the characteristics of a highly effective CEO? And the second question, it's when you're conducting due diligence or initial due diligence, how do you determine the risk or the critical level of involvement with the business owner? And from that, how do you determine which customers are there because of the relationship with the business owner? So part one of the question, what do you look for in a good CEO or a good leader? Part two, how do you measure how critical that person is in the day-to-day operations? Vik, you probably had to look at this a lot lately since you will be the new CEO, the new owner. So let's start with you.
Yeah. So as a preface, for me, it's not necessarily important that the CEO is perfect. I'm looking to transition into that role. And so, I cited one example where the CEO is kind of a jerk, and that's not a situation I want to be going into necessarily, even though, maybe that could set me up for success in some ways. But more so, I think I look for someone certainly that has good leadership characteristics, but really is someone that I could see myself having an ongoing relationship, because for at least 6 months, I'm going to be sitting next to this person, learning from them, doing this transition. And then I always look for situations where the owner is willing to roll some portion of equity, maybe 10 to 20%. And so I want to know it's someone that fundamentally believes in the business and is willing to be supportive, is willing to pick up the phone when I call 2 years from now to ask about setting up a lunch with a key customer or something like that. I won't go into leadership because I could talk about that for hours, and you could fill libraries with what that looks like. What I will say is if I were someone on the call that's thinking about selling my business and how should I prepare it for sale, I would really encourage you to think through the framework of, are you working in the business or are you working on the business? And if you're working in the business, as in you are also the chief salesperson, or you're also the head of ops, or you're also the person that procures all the supplies, or whatever the case might be, that kind of can be a risk for someone who's a potential buyer that knows, hey, this seller is going to exit, and now we're going to have a gap on the management team for a really critical function. Alternatively, if you put yourself in the mindset of, I have to work on the business, I can't be too much in the day-to-day, then you can work on improving some of both the drivers of the business and the destroyers of value that we talked about, because you can be looking at your business holistically as something you want to sell, rather than, hey, I'm someone who's kind of in the weeds all day, every day.
Well said. I agree. If you can remove yourself from the day-to-day, you can focus on, growing or improving the business, not just running it. Let's see. All right, we'll do this last question. I know we're running over a little bit, but the question is, and I think this applies across the board, but for an oil and gas company that has a very high concentration of revenue with one customer, I mean like 45 to 50%, despite any efforts to expand customers and products and services, what do you do there? I think this applies not just to oil and gas, but to everything. Because you're not gonna say no and not grow a customer because they're getting too big. And it's one of the things you really don't have a lot of control over as an owner unless you're focusing your efforts in sales and marketing. And so I'm going to toss that one up to any of you who wants to chime in. How do you control customer concentration or improve it, or how do you minimize the buyer's concern?
I guess I can jump
Yeah,
in.
take it.
Sure. So, yeah, I think specifically for O&G, it would depend what you're talking about. Is it more upstream, downstream, midstream? But in terms of customer concentration, you want to understand, is there a path to change that, right? So are there other customers that are growing steadily where you potentially can grow into a more diversification of it? A lot of times it's hard to get comfortable with something that high of a customer concentration, because again, if the relationship goes sour, your business has half as much revenue. We've gotten comfortable with that a few times, and a lot of it is the idea of how are we growing into some of these other customers? How long-term is the relationship? How long-term are the commitments, right? If it's a situation where it's a pure at-will deal and they can change at any point, that's going to be a question. Is if the relationship is that you're extremely sticky and really important to their business, and there's huge switching costs, that's going to be important to kind of understand, right? As opposed to if you're just a commodity and they can change tomorrow over a penny difference, that's a much different thing than if you're integral to every aspect of their business and there's not a lot of competitors to switch to. So I would say those are some of the kind of the core things to think about. But again, if you're preparing to sell the business, I would look to trying to diversify that revenue and get some other customers in the door, or at least have a path to do so.
Well said. Yeah, I like that. I haven't thought of it from that perspective. Not just focusing on bringing in new customers, but to really solidify it by seeing how integral you are in their operations, making sure the buyer is aware of it. Really good points there. So. Well, we're a few minutes over, so I apologize for keeping everyone, but want to thank each of you for joining us today. We've really enjoyed having you. Great insights. I know all of the folks that joined us today are taking notes and really appreciate the valuable information that you've provided them. Real quick, I'll just say, look out for the next series that we're doing at the end of the month. Kind of a good overlap to what we talked about today, but practical tools that you can do to prepare your business for sale. Some of the stuff that we talked about today, and we'll be hearing from Carl Meyer, but keep an eye out for that. It'll either be on our website or you'll get some email blasts and whatnot. But I guess any closing remarks, guys? Thank you for joining us. Anything you want to say? All right.
Thank you for having us.
Yeah, thank you.
Yeah.
And by the way, if anyone has any additional questions, I'm happy to provide my email, or if they want to ask questions, again, happy to provide that and take some time to answer those questions.
Likewise with us. Yeah, we'll for anyone that wants a recording of this, it's on our website. It'll be in the follow-up email. But Jason, Vik, thank you so much for joining us today. Thank you to everyone that participated. Thanks for the questions. And we will see you all in a few weeks. Thank you.
Thanks, guys.
Bye.